The level 4 lockdowns here in Melbourne and level 3 for the rest of Victoria have meant downgrades to the likely profile of the recovery out of Australia's recession. A quick summary of our updated view on the economic outlook. Victoria's second wave of COVID-19 infections has been devastating and confronting. But beyond the health implications, the jobs market is clearly at risk. In the first wave, it was hospitality, arts and rec, and tourism-dependent sectors that were hit hardest. But this time, construction and retail will join a range of businesses trying to get through these severe restrictions. The infection numbers released daily will be more insightful on the most likely direction for the national economy than the economic data itself. But to track the financial impact of the global pandemic on households, it's employment numbers that give the clearest view. Nationally, 13 million Australians were employed in February prior to the pandemic, and that number fell 7% to 12.1 million before recovering a little in June. The July numbers will be released later this week. Naturally, the Victorian events put this recovery at risk, and total hours worked, which initially fell 10%, is also at risk. But the latest easing in eligibility rules for JobKeeper will help, especially if we avoid the need for further restrictions in other parts of Australia. The RBA have updated their base case for unemployment to reach 10% by year end, before very slowly recovering. And we expect the Victorian rate to exceed this, but a much lower rate elsewhere. Federal government fiscal support packages have grown to around $230 billion, or 12% of GDP. And further extensions to this support should be welcomed. They do come at the cost of government debt, but it's important to keep in mind how favourably our numbers compare on that front as a AAA-rated economy. Australia's net to GDP ratio has risen from 19% last year to around 25% today and 35% next year. Gross debt is around 35% today and heading for 45%. But these numbers are the envy of most economies around the world. The government can access funding at under 1% for 10 years, and Australia's growth rate for the decade ahead should be more than double that rate. So, in a low inflation era, this approach does make sense. The financial markets, therefore, are seeing unique conditions: a record high for the value of gold, a record low for long-term interest rates, and for stock markets, fresh record highs in the US indices. The fact that the US Nasdaq index and the broader S&P 500 have held up so strongly despite COVID-19 conditions in the USA shows their reporting season has been faring better than feared, together with ongoing monetary and fiscal support. And similarly, here in Australia, reporting season is upon us. Investors will be looking at the short-term impacts, but also an eye to longer-term prospects, including assumptions about the viable vaccine being successfully trialled and then made available. So once again, the outlook for the markets, for jobs and for society rests with the health crisis and how effectively we manage it. And lastly, property prices have been diverging in the pandemic period since March, up in many regions and in the capital cities of Canberra, Hobart and Adelaide, but 0.5% lower on average in Brisbane, 1.7% in Sydney and down 3.5% in Melbourne. Making predictions in this environment is harder than ever, but we can be very confident that the RBA official cash rate will stay at 0.25% for years to come, and that the government can continue to afford to provide fiscal support as required. So, assuming the health crisis can be effectively managed, the long, slow path out of recession will gain momentum, and the relativities of our economic strengths can come to the fore. And that's the market update from Bendigo Bank.